Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over Twitter, go over some information. I'll give you my financial opinion here on what we're seeing on Twitter. I do this to get other people's viewpoints instead of just mine. I do a lot of charting myself, a lot of fundamental analysis. The fundamental analysis basically is looking at inventory levels, deficits out in the future, what the cost curves are at for a lot of these commodities. And the reason I'm focusing on commodities is because commodities are in cycle. They're in cycle because of the valuation levels that were reached in 2020 and based off of the market conditions, which I think is an inflationary environment that's coming, which shifts the preference of investors from stocks and bonds into commodities and precious metals. We also have an investment cycle that's been underinvested for a variety of reasons in commodities itself. Way underinvested, like never seen before types of market deficits and imbalances out in the future for commodities. So that's why I'm focusing on commodities, because that is where the value is and that's where the opportunity is over the next decade. Now, I understand a lot of people take short-term outlooks. I invest in companies or trade. This is a big, long trade, so to speak, over the next decade. Maybe longer, maybe a little bit shorter, but it's probably going to be around 10 years, 2030, 2028, 2032, somewhere around that time frame is where some of these commodities could eventually peak at, or maybe it goes on for the rest of our lifetime if we're constrained to only the earth because of limitations of resources. So that's kind of my overall overarching big picture view and look when looking at this stuff. So let's dive in. I'll give you my opinions on what's going on around the world. And if you want to follow me, you can go. It's at finding_finance if you want to follow me on Twitter. And these are a lot of things that I retweet. Sometimes I post things myself. And a lot of it I do and release to the channel here. And I also obviously have the finding-value.com in the lower section there. And if you want to become a platinum member, I've got a lot of this information on cost curves, on market deficits of a whole bunch of different minerals, a lot of different companies if you're a platinum member. And we do question and answer sessions and training. I have training sessions, technical analysis training sessions all over the place on the website. So looking at this, we've got Tavi. Tavi is saying oil prices now sitting on major support. Supply is tight. Aggregate capex for energy companies remains historically depressed. And long-term fundamentals is attractive. Good place to start adding here if you ask me. And in technical analysis, we just do these easy long-term charts. And there's a couple of things that stick out in this chart when I look at it. So the first thing is we have a consolidation. A consolidation is a period of, we'll call it unfavorability for oil. That started in 2007, 8. 8 is where it crashed, but it was coming up in 07, 08 where it peaked, turned, and crashed. And it crashed all the way for about 12 years. In these big consolidations, you get 3 humps. 1 hump, 2 hump, and then the 3rd hump. And then you usually try to break higher. Sometimes this 3rd hump goes straight up. Sometimes it crashes down and we get an end of trend capitulation type sell-off, which we did in 2020. That is the start of the bull market in oil. Now, I know a lot of people are thinking that the bull market in oil, that inflation is cooling down, it's all done. I disagree. When you go up, you usually get 3 distinct waves. Wave 1, wave 3, and wave 5. The pullbacks are 2 and 3. But I think that this pull up above that resistance line, which is a breaking of a trend. So that's also important. What we're doing is we're breaking the consolidation trend resistance line that we've broken, and now it becomes support as you come on back. That is, so our end of trend was in 2020 with the capitulation sell-off. We've got the herd mentality technical analysis of 1 hump, 2 hump, 3 hump, end of trend with the capitulation sell-off, and now we're coming back up. We've broken the downtrend line, and now we're in a new bull market. Now, this isn't the only thing that's broken. We've got broken yields to the upside, which means that we're in an inflationary environment. We have broken producer price index. We have broken trend lines in other commodities. We have broken ratio charts all over the place, all favorable commodities. Now, that can't happen unless there is a major shift, paradigm shift in a macro trend. And this macro trend that's coming is favorable for oil. Now, we're in a pullback. People are looking at price, creating their narratives, creating their stories. I don't think this is necessarily done going to the upside. Now, could we pull back a little bit below this support level? Yes, we can. It is possible. But this is generally where I start to get crazy on loading up for new positions on top of my old positions that I created in 2020. So this is looking very good. It's very positive. Everything looks bullish on oil prices, even though everyone is negative in sentiment. There's your opportunity. Negative sentiment. We're sitting on support. And sometimes when I draw this, just to let you guys know, I drew another line down here, which is a possibility if it were to come back to the bottom here at about $62 is possible. And it's even possible to go a little bit lower than that. I highly think that's highly unlikely. I do think that 70s or even high 60s is a good spot where we could get some good support if it were to get to those levels. It could obviously hold at the support level that we're at right now. It says, according to API, crude inventory has dropped by 25 million barrels over the past 4 weeks. If the trend continues throughout 2023, inventory will drop by 300 million barrels, and it will eventually be at 100 million barrels. This here is the fundamentals of crude inventory. This is what gives me the confidence to load up at those support levels and to identify technical analysis and break that downward resistance trend line that we saw. So what this is telling us is that our inventory levels are getting eaten up, and I think we were still releasing from the Strategic Petroleum Reserve at this time. It means there's imbalances in the market, and they're big. This here is the investing opportunity, and the opportunity comes when you have negative sentiment in the market and everyone is selling something, and you take the opposite position and do opposite of everyone else. That is where you become successful, is when you do opposite of everyone else. I don't want people to agree with me. I want them to tell me I am wrong. And if I am wrong, that means I'm right to buy, if that makes sense. And it's a difficult thing to do because people want to they want to move in herds. They want to move with the herd. They don't want to be Han Solo. They don't want to be the guy or the girl that is by themselves making and standing on their own decisions. That's what makes this game hard, is because everybody wants to fit in and they want to be a part of the crowd. It says free cash flow yields for selected Canadian oil and gas producers at the current strip price. VET includes the $400 million in windfall tax. But yet, their free cash flow yield is incredibly high. And keep in mind, though, free cash flow yield can be good, can be bad. You want to buy these things when they're out of favor, when they miss in earnings, but everything looks good. When they have a windfall tax and everyone's selling, that's when you want to get interested. Now, keep in mind, some of these that have free cash flow that's low, they're going to be the most volatile when the pricing, the commodity pricing, becomes favorable for oil and natural gas. So these are going to go up the most likely. MEG and the CJ is Crew Energy, or no, that's that Crew Energy or Cardinal. I can't remember which one CJ is. CR, yeah, CJ is Cardinal, I think, and CR is Crew. But these two will go up the most likely, and this one is out of favor at the time. And that's some things that I look at. It says U.S. total crude inventories, both commercial and strategic petroleum reserve, have fallen to a 36-year low, dropping below the previous bottom set in 2001. Now, here's my question. Let's wipe your entire knowledge of pricing off the face of the earth. And let's just look at this from a completely neutral standpoint. If this was crude inventories, commercial plus strategic petroleum reserve, and you were to say, what was the pricing at 2016 or something? This should be a low price here and a low price in 2020 here. These should be low prices. Now, what do you think the price should be when this is drawing down all the way down here? Well, it should probably be pretty high. It should be very high, especially if this is an inventory level against a much higher production number than back here, because production was far lower during this time frame than what it is today. This might be 60, 70 million barrels versus over 100 million barrels today, or about 100 million barrels. So our inventory in relationship, it's a ratio, our inventory in relationship to how much oil we use is at a very low level. So someone with any logic would conclude that this should be at a pretty high price. It should be higher than any of these areas back here. And what's weird is in 2008, in this general vicinity here, we were at $150 per barrel oil. And up here, we crashed. We had inventories go up. And then if you look down here, we were pulling, oil was going back up, and then we had another crash. But oil should be much, much higher than where we are today, given the total inventory levels, period. There's no arguing that. And if you argue that, I'd love to hear your argument. Put it in the comment section. I'd love to hear why you think that oil prices should be lower after we've completely drained our inventories, especially from a supply side, and especially since the last 4 weeks, we've drawn down 25 million barrels. Tell me how that is bearish. Love to hear your guys' opinion. Demand is obviously not cooling off, and that is a highly speculative position to say that demand is pulling back from a recession, even though you've eaten 25 million barrels out of your inventories. So now we know the real reason why the West is so in earnest to get off oil. They can't control the flow of gold for oil deals. This is where they're scared. They have a dollar that is the reserve currency because of the dollar and oil's relationship. That is where they're gaining all of their power. But what happens when they lose control of the dollar not pricing commodities? And as they lose control on that, that is where all of their control comes from. It is the oil petrodollar power that they have. And they know that. And they're going to be doing everything they can to manipulate prices for gold and oil. It says, remember the Big Short, the movie. If you watch The Big Short, what did they do? What did Goldman Sachs and all these guys do? They didn't price the assets until they created a position. They may not have a position. They might. I don't know. But they're going to move it when they want to move it. They're going to scare people out of it and try to get even bigger positions. That's oil, the oil trade. Remember, next time you hate your life, it's all about perspective. I have a friend who reads 2 to 3 books a week, works out twice a day, and has people who want to have sex with him all the time, yet complains about how much he hates prison. I thought that was great, pretty funny. But yeah, it's about perspective. Now, here's one from Josh. I think Josh has his mind screwed on straight. Big oil bull. I think he's looking at the big picture view. He's looking at inventory levels. I like Eric Nuttall. I like Cuppy. I like all these guys because they take the big picture view, and this is what's going to make them successful. This is what separates a experienced investor versus someone who's new. The new person looks at price and creates a narrative. The experienced person looks at the data and draws logical conclusions from the data and takes positions based off the data, irrespective of price in the market. The price is creating the value proposition. When the price falls below, we'll call it the cost curves, when we need to produce more oil, that is the opportunity. It says Canadian oil and gas companies with mostly rising short interest, getting into nosebleed levels versus recent daily trading volume. So some of these guys are getting into highly shorted positions. A position that has more shorts on the left-hand side here, like Surge Energy, Athabasca Oil, Journey, and some of these other guys, when they start loading up on the shorts, and if they're wrong, and this all reverses, those shorts have to cover. So these are probably going to be more powerful than some of the ones on the far right-hand side. That doesn't mean it's 100% the case, but it just in general, if you're on the left-hand side over here, these will have a little bit more pop than the ones on the right-hand side. To a degree. It also means how much money's coming into it, what's the share float, that's the number of shares that are potential to buy and trading. That also matters in the size of the market cap. So some of these could be small market caps over here, and some of these guys won't short them because they're very volatile. We've got, we've done that one. It says Russia's seaborne crude oil exports have halved in the past 48 hours. That's crazy there. This is Grady. It says the chart shows that when SPX cannot outperform the U.S. producer price index anymore as big inflation starts, gold starts to outperform the SPX. It means that gold reacts to big inflation, just as it should historically. A global paradigm shift is in the making. And what's happening is he's taking a massive, big picture view look, charting this out in a ratio perspective. He's got two separate ratio charts. He's got the SPY divided by the SPX, gold divided by SPY, SPX. And he's got the SPX versus the producer price index. And what we've seen is we've seen the SPX outperform the producer price index. This, by definition, is basically a disinflationary environment. This here is a market condition that we should be watching. Conversely, when you break out of this lower trend line, what we have is a breakout, BO, the back test, and then we're going to see a move lower. What that means is that the producer price index is outperforming the S&P 500. That inflation of these companies, the producer price index inflation is beating the SPX returns. We are in an inflationary environment. Now, under an inflationary environment, when we look at those market conditions, what we've seen in the past is that gold, precious metals, oil, commodities, they outperform in these types of conditions that are coming down here. So when we look at the upper one, gold should be outperforming SPY, which is the S&P 500. We were in that disinflationary period here. You can see conversely that this goes up, this is down, and we're going to start to break to the upside here. We've got a nice lead-in pattern here. We come up, we pull back, and then we're going to hit the big move here. I think that move's coming at any second. We're going to have a large move of outperformance of gold in relationship to the S&P 500. That could mean, and probably means, that gold will go up the same time that the S&P 500 will either go sideways or down. We are at an inflection point. This is where you make a ton of money, is when you're early in an inflection point where a paradigm shift is occurring, much like 2012 or 2009. These were inflection points for the S&P 500. This is where you want to get long the S&P 500. This is where you want to get long on gold. So there's that, or any precious metal for that point of view, gold, platinum, and silver. So we'll look at this. $500 oil by 2030 shouldn't surprise anyone based on the technical pattern. A backtest of a massive bullish falling wedge to around $60 could happen first. But the chart says inflation will rule in the 2020s. So we had a consolidation period, 1 hump, 2 hump, 3 humps. We break, and then we have an initial first wave, and then the second wave pullback, and then we get a big move higher. Now we are in another consolidation period that we had, 1 hump, 2 hump, 3 humps, and then the break higher. Right now, if you zoom in on some of these companies, we are putting in a 3-hump pattern. And we are right coming in this general vicinity of this hump, the third hump, somewhere in this range on a lot of companies, a lot of them. We talk about those companies. I show you the patterns in the Platinum membership on the finding-value.com website. And that's where I have a lot of my picks for potential investments. Right now, we are putting in this third hump bottom, right at the bottom where we are today. We could have a little bit more downside left in this move before a gigantic third wave that's coming. This is the third wave, and then we have a fifth wave. If we have the same type of breakout move that we had in the mid-2000s, this will go to $500 a barrel in 2028, 2030, whatever that exact time frame is. That is what's ahead of us. This is the big picture view. This is what the experienced investors look at, the new investors look at, the yearly little moves that make. So we had a breakout, a retest move, and then we're going to see probably a very large move coming, what is considered to be the third wave. Now, this first wave and the second pullback here, we call it the second wave pullback, that may not be done yet. It might be, it may not. So what I do is I take a strategy where I positioned in the 2020 timeframe, I'm continuing to stay long, and I'm going to cost average in to try to get as best as I can in this bottom that's coming up right now, because we have a 3-wave consolidation pattern before a massive move higher. I am ultra bullish on oil and natural gas and energy in general. And I don't think they can stop this. I think they can delay it, but I don't think they can necessarily stop this big move. It is driven by the structural underpinnings of demographics in the world, and not just demographics, I should say demographics and third world countries coming into more riches to increase their consumption of energy. It's that simple. It's structurally driven, and I don't think there's anything that can stop this with the underinvestment that we've made in a lot of oil. And I don't even know if the underinvestment has that much of an impact. It may not be as much as we think. And keep your eyes on shale oil. If they cannot produce more supply from shale oil, if that really starts to flatten out, I think we're going to see some problems in the world with energy shortages, perhaps. High-priced energy, I'll say it. It says, shouldn't they be applauding Joe Biden for doing their part in OPEC+ agreement? We're cutting our oil production. We're cutting our oil production as he doesn't want to produce oil. Oil is a master commodity. That is something I think that's a big play there. Now, here's another thing. I talk about confluence. Confluence is the merging of information to give you a picture. So copper is signaling big inflation ahead. And it's partly inflation, yes. Copper is also signaling that it's got a fat shortage that's coming. Now, when we take a big picture view and we apply the same principles that I'm talking about here recently, I apply the same principles, all right? 1 hump, 2 hump, 3 hump, go. 1 hump, 2 hump, 3 hump, breakout. Now, what we're seeing here is we have a breakout, a back test. Just like what? Just like oil. Just like all these other commodities that we watch. I think we're going to see a big move in copper here coming up. It's going to grind higher. It's going to be the same thing. This is the breakout, back test, boom. Breakout, back test, boom. Now, I've been talking a lot about the Platinum membership and a lot of the Platinum members. We have a lot of companies that are based off of this trend that's going to happen going forward. We're looking at diversified mining companies. We're looking at dividends. We're looking at all of these types of investments that we can have based off of these big picture view things. And we talk about the big picture all the time. And hopefully they're watching these YouTube clips so that they have the confidence to stay long during these big commodity bull cycle that's coming. This here is the herd lining up copper to go higher. That's really what it is. So that looks really good. It says, this is Grady again. It says, here's the very big picture chart showing how extremely undervalued commodities are even after a 220% baby bull move. The glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. Global capital flows are changing. What this is the CRB index in relationship to the Dow Jones Industrial Average. Remember about a lot of the things that I say, a lead-in pattern, a double bottom, and we're at the bottom of the double bottom. And this is the everything but commodities bubble that's happening. And what that means is that all the money in the market has shifted to stocks and bonds. That money flow is going to rotate back out and be shifted back to commodities. And we haven't really had a large move in commodities yet. We're looking for a 36x in this commodity move. We've got the chart is preparing for a slingshot look. The slingshot is basically you pull up, you slingshot down, you get people short, and then it just rips it. And it's going to be, in my opinion, a combination of the Dow Jones going down and commodities going up. That's how you get a 36 outperformance. So stocks going down, commodities outperforming going up. And that's where you get your purchasing power gains. It says another week, another big U.S. oil inventory draw. These weeklies are unreliable, particularly from API, but multiple consecutive oil inventory draws are very bullish. Big draws coming down, guys. Oil is coming back down. I like this girl's quote. She said, the ultimate flex is not to retire early. It's not having to think about retirement at all. that is a great comment there. Down another 1.5% today as 135,000 ounces of platinum remain. So we are eating through our inventories on all of these different metals that we look at. Copper, zinc, aluminum, nickel, platinum, silver, gold, oil inventories are dropping. Everything is dropping, guys. How is this a bearish picture? So although price can be bearish in the short term, the fundamentals always win in the end. And we're seeing inventories drop. There's a huge decline there. It says, that said, we're back at testing the rising blue trend line support. It really needs to hold, or we see below 70 for oil. This one's a couple days. We did break below 70, or no, we're still above 70. But we could go below 70. It is a possibility. And I'll end it there, guys. But that's what I've got for today. And hopefully you guys enjoyed this type of analysis. And I'm just talking, other people's charts. I do this charting myself. I try to get other people's big picture views. Now, why don't I have any bearish information here on commodities? Because there isn't any. There's no bearish information. We're not increasing inventories. We're not increasing investment. There aren't new mines coming online. Inventories aren't. There's no bearish information. I don't have any bearish technical information from a big picture view. In the short term, things can pull back. I agree. Big picture view, though, looks pretty bullish to me. Let me know what you guys think in the comments section. If you think it looks bullish or bearish, and you think things are going to go down, put it in the comment section. Love to hear your opinion on why. But that's what I've got for today, guys. Hopefully you're having a great day. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you later. This is Finding Value.